Good morning, everyone, and welcome to Exploring the Rennie Landscape, our current market explained. My name is Cassidy Bast, and I'm the Director of Advisor Growth and Career Development here at Rennie. Today, we have a presentation in store for you that covers topics that impact every area of our society. So twice a year in the spring and fall, Rennie Intelligence produces a little red book called the Rennie Landscape. This is one of about 100 annual publications put together by our fabulous team of market analysts. And while many of these publications look at the housing market, the Rennie Landscape is a little bit different in that it offers a big picture, more of a macroeconomic lens into the factors that both directly and indirectly move our market. Things like economic trends, employment, demographics, interest rates, inflation, policy, job growth, and migration. So all of these things define the context for our market and impact the decisions to buy, invest, and sell. So in addition to our presentation today, as usual, we will be having a Q&A period at the end. So be sure to put your questions in the Q&A button below, and we'll do our best to get to as many of those as we can. We're also going to be offering 1 PDP credit for those industry realtors to attend for the complete hour. If you're an advisor with us, that will be submitted automatically. And if you're a guest here today, we will be emailing you a certificate of completion, which can then be submitted through the Real Estate Board of Greater Vancouver portal. So now I'd like to introduce our presenters. They are 2 of our MVPs here at Rennie. They're a lot of fun to work with, and they bring that same energy when breaking down what is quite a complex but important topic. So if you're an advisor with us, you hear from these 2 often as Intel Insights are part of our regular conversations here at Rennie, featured in our various events, including our sales meetings and Monday morning coffee education sessions. You can also catch these 2 discussing the market in our Rennie podcast and through subscribing to our Rennie Intelligence reports by signing up on rennie.com/intelligence. So without further ado, I'd like to welcome Ryan Berlin, Rennie's Senior Economist and Director of Intelligence, and Ryan Wise, Rennie's Senior Market Analyst. Berlin, I'll let you take it away.
Awesome. Thank you, Cassidy. Thank you, everybody, for taking time out of your day this morning to tune into this. I'll start with a little preamble before we get into the actual data. And just, when I've talked about this before, but, our industry, the real estate industry, and then this company, Rennie, and within Rennie, the intelligence division, we all produce a lot of content that is really focused on unpacking how the housing market is changing according to, all of these traditional real estate metrics like sales, inventory, prices, so on and so forth. Those are what we call the whats of our market. We call them the whats. I think what's as important as the whats, or more important, are the whys. So when we look at our market at a point in time like now, we ask, well, why are sales counts as low as they are? Why hasn't inventory expanded more? Why are prices dropping? And why do we feel the way that we do about the future of our region? And that's really where the landscape comes in. So, as Cassie sort of ran through what the landscape is. It's the little red book. I've got a copy right here, and we've got a digital copy on our website. You can go to rennie.com/intelligence, and you can access it there as well. So yeah, we just essentially provide an update on all of those things that directly and indirectly impact our housing market here twice a year, in the spring and now in the fall. And I think particularly when the world's going crazy like it is now and like it has been, it's a good way to sort of anchor perspectives and data at least a couple times a year, because there's just a lot going on and it's hard to digest it all. And I think where I think the landscape, in addition to presenting a lot of good information, where it plays well is, you can read it if you're really interested in this stuff, and not everyone is. You can read it cover to cover. You read it from front to back, and you'll see themes emerge and reemerge throughout. Or you can jump in, you can read it piecemeal if you're just interested in say demographics or in the labor market. Well, you can just read that stuff and you'll get what you need out of the report. And it's been written for, it's a little bit of an elevated piece. So if you don't know, if you're new to this region or you don't follow sort of broad macro trends, or you don't know anything about real estate, certainly there's a lot to learn from it. But I think ultimately it's geared to those who have a little bit of an understanding and perspective on our housing market, whether you're a realtor, developer, investor, buyer, seller, would-be buyer and seller, or just, again, somebody who it takes an interest in our market. So as we sort of get into the data, we continue to be in a very dynamic economic and housing market environment. And it is really difficult to distill what matters and what doesn't matter. I think for all of us, whether we're looking back over the past 2.5 years, or we're looking back over the past 6 to 8 months, it's felt pretty challenging, right? And maybe even more so today than before that. So it's almost, there's just a lot to contend with, whether we're looking at inflation, we're looking at interest rates or other things. There's a lot of volatility in our market. So, but I just wanted to start with this slide because it's easy to be pessimistic about the world and our region and the market and the economy. But ultimately, we're pushing through this, and we will come out the other side because the market goes through cycles, and we'll come back to that in a moment. So I'll start with, we've got 3 key insights that we want to explore today. I'll start with the first one here. Essentially, where are we today? And it has been a lot. And then I'll kick it over to Ryan Wise to talk more about what we're seeing across the landscape of economic indicators today. And then I'll pick it up again at the end, and we'll talk a little bit about what we see ahead of us. So yeah, obviously, again, so much going on. And I think you think about how we consume information these days, right? We're always on the go. We're usually doing something in addition to reading an article, right? Like we'll be watching TV, or we'll be exercising or eating or hanging out with the kids. And so we're always on the go. And I think news outlets obviously know that. So the content, the headlines are crafted in such a way that they're trying to get our attention, our fleeting attention. So we're bombarded with statistical tidbits and often sensational headlines. And I know it's cheesy, but I'm beginning to think, as I look at these headlines and I contemplate it more, that they're called headlines because they give us lines in our head. It's really hard to understand what's going on by just reading headlines. That said, when you consider what we've gone through over the past, call it, couple of years, it is a lot from COVID, supply chain disruptions that resulted from that, a very high inflation and interest rates that went from nothing to over 3%, weather events. We had the heat dome last year, and then the atmospheric river, which has wiped out swaths of the province's agricultural land for a period of time. Our highways, we still have bridges that haven't been rebuilt. There's a lot that's been going on. So the question is, where are we today, having come through at least some of that? So just starting with our resale market, as sort of a barometer for the broader housing market. I think the big theme right now is that sales are down. They're depressed. We've had, as of September, which is shown on this chart here, this is total sales in the Vancouver region. Vancouver region is essentially, in this context, it's from Squamish all the way through to Abbotsford. And sales are down, versus last September by 48%, but more importantly, they're 36% below that 10-year September average. So, a more typical number of sales for this time of year would be about 4,000. We're at 2,500, and that continues a trend that we saw in July and August as well. And if we look at more recent data, we track this stuff on a daily basis. If you look at that red line on those charts, we have the last 3 months of daily sales. For October here, you can see that we're tracking far below where we were in 2020 and in 2021. And we're actually on pace for about 2,800 sales in October. So, if we hit that mark, and or let's just say if we don't hit the 3,000 mark, we will have had by the end of this month, 4 straight months of fewer than 3,000 sales. And I think the last time we saw that was at the end of 2018, the beginning of 2019. So it wasn't even in the depths of the pandemic that we saw such consistently low sales count. So the buy side of the market is hesitant, is depressed. And so it's interesting because you would think because there aren't a lot of sales that the market conditions generally would have tilted, quite clearly in favor of buyers, right? And so we can look at that through a couple of different metrics. This one here is called months of inventory, and it's essentially we divide the number of sales in a month into the number of homes that are available for sale to look at how, at the current pace of sales, how long the current inventory could sustain demand. And so the higher that is, the more the market tilts in favor of buyers, right? You have more selection for a given amount of buying activity. And when it's lower or trending down, it tilts in favor of sellers. So if supply is relatively scarce relative to how much demand there is, then we tend to see prices rise. Now, where we are now is we were in a deep seller's market for a couple of years. And certainly the detached market has moderated significantly, but really we're talking about, relative balance in that detached market to this point in time. Now, we could see it move further into buyer's territory, but for the time being, we're sort of on that cusp of a balance versus a buyer's market. And that we also look at the multifamily side, so townhomes and condos. It isn't a deep seller's market. The playing field's tilted a little bit towards sellers, but it is really sort of on the cusp of being balanced. And the question is, well, how is this the case if sales are so low? And the issue is supply. So new listings, so the number of homes that are newly listed each month is down, right? So we have one of the lowest months on record, 6,400 new listings across the region in September. So that's down 13% versus last year and 17% versus the past 10-year average. And so when we look at that dynamic between sales and new listings, sales take away from inventory, new listings add to inventory. And then within that too, we have listings that expire or canceled for whatever reason. And so all of those different sort of interactions with inventory generate upward movement or downward movement in the supply of homes. And so we're at about 15,000 homes available for sale. So all types, all ages, all conditions across the region as of September. It's up from last year, but last year was a historically low year for inventory. There was nothing available. There weren't a lot of people listing. And on top of that, demand for sales counts were relatively high. So even in this environment today where sales counts are very low, there isn't a huge, there isn't a swath of available supply for buyers to choose from. It's 21% down from the typical level this time of year. And then if we look at inventory into October, again, this is daily data. As of today, we're sub 15,000. And we'll talk more about where this could be going later on, but we're down significantly from what a typical level would be. And that's continuing into this month and is likely to continue through the rest of the year. So, all these dynamics have impacted prices and they have come down. So we look at benchmark prices, which for the purposes of tracking values over time, this measure comes with its shortcomings, but in many ways it's superior to an average or a median price measure, which experiences a lot more fluctuation for a whole bunch of reasons. But when we look at the Greater Vancouver Board area up top here, and then the Fraser Valley Board area, which is essentially south of the Fraser and into Abbotsford, we see declines across the board. We see bigger declines in the Valley than in the Greater Vancouver Board area, because we also saw a bigger run-up in prices in the Valley during COVID, as people were chasing the extra space and the relative value that existed out there. And what's interesting is, as a bit of a side note, values are still up per the benchmark versus last year. So we've had quite a volatile path to this point, but on a year-over-year basis, values are still up. Now, I think we'll have a conversation. I think that those price gains will be eroded over the next few months. But as it stands right now, despite the significant declines from the peak in April, prices are still up year-over-year. And so, people look at, you try to find silver linings and things, right? So, if you're a buyer, for example, you see falling prices and you think, well, all else being equal, maybe that represents an opportunity. So it makes homes more affordable. But of course, we have to weigh the price declines against the increased cost of borrowing. And part of the reason, one of the main reasons that prices have come down is due to rising interest rates. And so what this line shows, so this chart on the bottom shows the percentage point increase in an interest rate. So running it all the way up to 10 percentage points increase over a period of time. Hopefully we never get there, but just for the sake of completeness, mapping this out. And then on the vertical axis, we have home price declines. And so what that line, the series of dots represents is a set of constant monthly payments for each pair of interest rate increases and an accompanying home price decline. So the example on here is that a 25% decline in home prices would offset a 250 basis point or a 2.5 percentage point increase in the cost of borrowing. And if we had that trade-off in prices against falling prices and rising rates, monthly payments would stay the same. So a household could get into the market, say, oh man, like my interest costs are much higher than they would have been, let's say 6 months, a year ago, but because values have come down, I'm able to get in and my monthly payments are what they were, let's say back in April, right? Another way to look at this is on either side of this line, we have pairs of interest rate increases and home price declines where you end up with higher monthly payments because the interest rate increase exceeds the compensatory home price decline. And then you have the obverse to the bottom left of this chart where you actually get lower monthly payments, where the decline in home prices, I mean, this is an extreme, there are extreme values on this chart. This does not imply that we're going to any of these places on either side, but just as a way of showing an example, big home price declines combined with modest increases in interest rates would result in lower monthly payments. So what matters is that we are north of the line. So right now, I mean, there's inflation everywhere. And it is all else being equal. We do consider the interest rate and the price environment for buyers, homeowners. It is more expensive than it was back in April. So, the resale market has sort of the broad-based impacts from interest rate increases and loss of confidence and so on and so forth. We're also seeing it in pre-sale. And we always talk about how the resale market really sets the foundation for activity in the pre-sale market. In pre-sale, you're buying a home that doesn't exist today, right? You're buying a home, someone's promising you a home in the future. And so if you are buying, let's say, a home in a concrete structure, a high-rise that's going to take, from the time that you write your contract to commit to that purchase, and when you get the keys to the place, it could be 4 years, right? So, are you going to be super excited to take on that acquisition if you think that prices are going to be declining in the future? Probably not. What informs that perspective? Well, the resale market often, because that data is published very frequently, widely throughout the media. Our local real estate boards publish a great deal of detail, and other outlets as well, including ourselves, every single month. So people tend to be quite aware of how prices are changing in resale. And we've seen declines recently, and we've seen buyers step away from pre-sale. So if we look at the first 3 quarters of 2022, at roughly 12,000 pre-sales, concrete, wood frame, and townhomes throughout the region, it's less than half of where we were last year, and we're 3/4 of the way through the year. I will say last year was a record year. Like we're not likely to see 26,000 pre-sales for a while. But that being said, we've really seen a slowdown in sales more recently on the pre-construction front. And all of this sort of reflects the chaos in the market. There's just a tremendous amount of uncertainty, and we'll come back to interest rates and we'll come back to inflation. But if we look at a cross section of indexes and markets, whether it's for commodities, it's stock indexes or whatever, we are seeing a lot of. It's not just unidirectional. It's not that commodity prices are going up and stock indices are going down. It's that they're changing dramatically from day to day. Like the Dow Jones one day might go up 2.5%, and the next day go down by 3%. It's just a lot of movement, and it really paralyzes everybody, anybody who's looking to make some sort of financial commitment. right? Whether you're a household, an individual, a business, or whatever. And so again, a lot of this reflects sort of the inflation interest rate environment. Canada is looking at a 7% inflation rate. We just got new data yesterday. So we're running hot. Not quite as hot as we were a few months ago, but way outside that 1 to 3% range that the Bank of Canada wants to see us in. Notably, this is not just a made in Canada problem. This is a global phenomenon, and it has to do with the monetary and fiscal stimulus that we saw at the beginning of COVID. It has to do with ongoing supply chain disruptions. It has to do with changing patterns of consumption, like us as consumers started spending on different things over the past couple of years because, I mean, we were in lockdown or we weren't able to travel as much. So our money that we were spending was being directed into places that to degrees that we hadn't seen before. And then, the war in Ukraine this year obviously has reminded us of what it means to be globally integrated. There's so many benefits to it, but then you realize, like, holy smokes, like there's this war in Eastern Europe and it's having material impacts on my life here in the southwest corner of BC. But this is something we're seeing around the world. As I said, interest rates, or the inflation rate more recently at 7%, that's the yellow line to the right of this chart. It's come down from the peak of 8%. That's good. Core inflation remains pretty persistent. It's kind of flatlined. So it's pretty broad based now across our economy that we're seeing upward price pressure. And as a result, we've seen interest rates, whether it's mortgage rates or on this chart here, we've got the Bank of Canada's policy rate, that light gray line at 3.25% that they'll be revisiting next month. All of those rates have come up to sort of disincentivize spending. And so we're in this weird period now for our housing market. Prices have declined. It's sort of people's heads are spinning. We go like, what does this mean? What's the context? And I think before I kick this over to Ryan, it's useful to consider the past two periods where we did see price declines. You can call them corrections. I don't necessarily like to use that word because it implies that the prices prior to the correction were incorrect. There's a lot more to that we can't unpack today. Back in 2008, that was the Great Recession. We saw prices for detached product and detached homes and condominiums in the Greater Vancouver Board area fall by 14, 13%. So pretty steep declines. And it took about a year and a half to get back to those previous prices. So it was a fairly prolonged downturn, but that was an economic driven downturn. The unemployment rate rose to 8.1%. It almost doubled in a very short period of time. And inventory, if you look at the August inventory, at the peak there, it was high. We don't have the context here, but those numbers were high, certainly high. I mean, even without townhomes, you can see that's 23,000 listings. I think we were north of 26,000 listings at the time overall, which is a lot. So that supply context really impacted prices. 2017-18, different context, because if you look down at the bottom, the unemployment rate really didn't rise a whole lot, 5.2%. But what had happened is prices had run up significantly. There was a lot of FOMO in the market and a lot of people furiously trying to get in. And so that did start to push prices upwards. And it got to the point where, buyers said, enough is enough. Like this is getting very uncomfortable. And the government, various levels of government came in and said, hey, we've got to do something here. The prices are out of equilibrium here. So we had policies restricting buying activity, foreign buyers, homeowners, people who were sitting on properties that were empty at the municipal level and the provincial level. There were policies that came in to disincentivize that activity. But it took quite a long time. If you look at the months to return to that previous high watermark for prices after the 2017-2018 dip, it was a prolonged period of time for that to happen. Very different from the economic downturn of 08. 2022, the drop so far, depending, like in this region, we're looking at between 5 and 7% drop in benchmark prices. Again, the unemployment rate's very low. And even the most recent data for Metro Vancouver's shows the unemployment rate 3.9%. Sorry to steal your thunder there, Rye. I know you're going to talk about that in a sec. But the unemployment rate, the labor market is performing very well. And if you look at the inventory right now, 7,000 detached homes, 5,200 condos, it's relatively low. It's relatively constrained. So it looks a lot more like 17, 18, and we know some policies are coming down the pipe as well. And the question is then, what's going to happen on the supply side of the market. That's the linchpin in all of this. Like how much longer will we be in this sort of downward cycle? And we'll talk about it more later, but there is a very strong relationship between the labor market and our housing supply. So with that, I will turn it over to you to take it from here.
Awesome, thanks very much. Okay, so insight number 2. Damn, it's windy. What do I mean by that? What are we talking about when we say that it's windy? So we like to speak often in terms of like headwinds and tailwinds, market forces, economic conditions that might impact our market, that might be a headwind for our market going forward, or a tailwind sort of pushing us along. And so when we talk about it being windy, what I'm saying is that things are changing so quick. Things are swirling around, pointing us in different directions. There's so much to unpack here. That these headwinds, these tailwinds, or these crosswinds, or these swirling winds, that everything's changing so quickly in our economic landscape. You name it, we're dealing with it right now. Things have changed so much from the last landscape to today in the past 6 months. And we really need to take stock of what's going on in our economy. And there's certain things that I think are really important to unpack here. And when we talk about our economy, I think the way that people really interact with it, first and foremost, is through the labor market. It starts with, are you able to find work? So I think we need to start with our labor market. And there's some pretty good news here. Headline unemployment rate is very good. So this data is from August, the red bars being the provincial unemployment rates. Canada's over on the left. And in August 2022, a national unemployment rate of 5.4%. That's quite low. It came up from 4.9% June, July, which was an all-time low for the country. And some other things to note here. The unemployment rate is down year over year in every single province. That's a really good indication. And over on the right-hand side, we have BC here, the lowest unemployment rate in the country at 4.8%. That's certainly a tailwind for our housing market. So since August, we've had a new release of data. As Brian pointed out, things are looking pretty good. This red line now is the Metro Vancouver unemployment rate going back historically. So we're down to 3.9% here in this region. That's historically low. For BC, it's 4.3%. Again, that's very low. And Canada dropped back down to 5.2%. So basically what we're saying is that people who want to find work are able to find it for the most part. And if I draw this line across historically, you can see that for our region, for our local economy, the unemployment rate is pretty close to about as low as it ever gets. So things are looking pretty good here in terms of the unemployment rate. But the flip side of this is there's a lot more going on with the labor market that I think we really need to address, because I don't think the unemployment rate alone kind of tells the whole story. So this chart here, this is for the province for all BC. We broke down employment by goods and services, types of jobs. And we looked at sort of pre-COVID, pre-pandemic, and the trends, the historic trends, and where we were likely headed. And then, of course, everything shut down in 2020. And there was a huge disruption in our labor market. And while we've recovered really, really well, if you do some trend analysis, you can see these red dotted lines here actually represent where we likely would have gone had it not been for all the associated lockdowns and the things that happened in early 2020. So what we can see here, in spite of historically low unemployment, we actually have fewer jobs than we otherwise would have at this point in our local economy, our provincial economy. So what this tells us is we actually need more workers. We have not enough workers for the amount of jobs we would expect to have. And another way to look at this is through the job vacancy rate. So this chart here is the ratio of vacant jobs to unemployed persons, both for Canada and BC. This is a relatively new data set that StatsCan only recently started tracking. We have quarterly data going back only as far as 2015. And this monthly data series, which is what I'm referencing here, actually goes back to 2020. So it is a record high, but not that long of a historical data set to look at. But what we note here is that there's actually more vacant jobs than unemployed persons, both nationally and in BC. So that says that there are 4 vacant jobs in BC for every 3 unemployed people. Or if you want to look at it another way, if every single unemployed person took one of those vacant jobs that exist, you would still have 46,000 unfilled positions, pardon me. So again, what does this tell us? Well, we need more workers. So if we look at this another way, this is now with that quarterly data set, it allows us to break it down by sector. This again is for all of BC. And what's going on with this sort of busy chart here is on the y-axis here is the year-over-year change in offered wages on vacant jobs. So how much are wages increasing on these vacant jobs that we have in our province? And along the x-axis here is the year-over-year change in the number or the percentage of vacant jobs, the job vacancy rate. And the first thing I would point out is that every single sector in BC had an increase in job vacancy rate over the past year. And almost all of those sectors had increases in the amount of offered wages that they're offering. The other thing I should point out over here on the right-hand side of the chart is the construction industry, which again, fairly important to a lot of people on this webinar today. And the construction industry in particular has really been hit hard by job vacancies. So there are, that is a 3.2% increase in the job vacancy rate, which takes us up to 10%, 10.6%. So 1 out of every 10 jobs in the construction industry is vacant today. And they're seeing 10% increase in offered wages. So clearly there's not enough workers, again, with a specific skill set for that construction industry. And they're seeing a really tough time filling those vacant jobs. And of course, that will have a direct impact on our housing market. So we're seeing this sort of mismatch between job openings and labor, especially in sectors like construction, accommodation and food service is another one with really high job vacancy rate. So from here, I think I want to talk about the work from home debate. There's been a lot of discussion over sort of back to the office versus work from home. What are the long-term trends, long-term impacts? So we have some survey data here, which actually says that the majority of Canadians aren't able to work from home. This isn't based, they didn't ask this question solely of office workers. This is everyone across the board. But 57% of Canadians aren't able to work from home. And I think what's interesting is there's quite a regional variation here. So in BC, that's only 52% of people that can't work from home. And without knowing the survey respondents, what type of job they're working or why they're not able to work from home, what we can see is that BC and Ontario, the two most expensive housing markets in the country, have a greater preponderance of work from home. So it could be something as simple as some employers are offering more flexibility for those who want to live further away, maybe commute into the office a little bit less. Or again, as we look at this job vacancy data and these offered wages going up, that employers in BC are offering more perks to their employees to either attract or retain talent. But either way, I think this kind of shows that this debate over work from home is far from over, and we'll hopefully get some more data on it in the future. The other big one I think we need to be looking at, especially in this high inflation environment, this rising and high interest rate environment, is our debt market. This data here is for all of Canada. This is the change in household debt by type for each quarter. And then this yellow line here is the year-over-year percentage change for all of that debt. So I think it's probably not surprising that in 2020 and 2021, household debt was increasing across the country. Interest rates were incredibly low. The Bank of Canada was incentivizing people to borrow, and they were borrowing at newly sort of record high rates. They took on a lot of debt that they hadn't really before. But the other thing that I think is important here is the gray bars here represents consumer credit, which often comes with higher interest rates, interest costs. And through 2020 and the early part of 2021, that was actually negative each quarter. So essentially, Canadians were paying off more of their consumer credit than they were taking on, while taking out more mortgage debt, which again at the time was much lower interest rates. But most recently in Q2, the Q3 data isn't out yet, we see that the second highest total for new debt in Canada. This data goes back to 1990. And so this is the second highest since 1990, the highest being Q2 2021. And that is actually the highest amount of consumer credit taken out in this time frame as well. So that's something to keep an eye on. Canadians are taking out more debt, even as rates go up. So we need to watch out and see how they're doing and how they're handling all of this debt. So given the pace of interest rate increases that we've seen this year, I think it's worth kind of taking a stock of, okay, well, how many mortgage holders are taking out fixed rate mortgages versus variable rate mortgages. Historically, Canadians have really preferred fixed rate mortgages, especially the 5-year fixed rate. That's always been the most popular mortgage product in Canada. But we can see here, this is again for all of Canada, this is monthly mortgage funds advanced by either fixed before more than 3 years, less than 3 years, or variable. And there's really been a shift over the last, call it, 1.5 to 2 years towards variable rate mortgages. So in this period here from 2017 to early 2021, we can see that about 20% of new mortgage funds advanced were for variable rate mortgages. And from that time to today, it's up to 49%. So about half of new mortgages in the last 1.5 have been variable. And then if we look at the total outstanding mortgage balance out there, pre-pandemic, it was 18% of all outstanding mortgage dollars. And today that's up to 33%. So it's almost doubled. There's a lot more Canadians out there, even though it's still the minority borrowers, there's a lot more Canadians out there holding variable rate mortgages. And we know these people are really susceptible to Bank of Canada interest rate increases if they take them. Essentially, the banks will increase the prime rate within a day of an announcement. So these people are feeling these interest rate increases. Especially the people on the right-hand side of this chart who have taken on a variable rate mortgage more recently. They haven't had a chance to pay down their principal very much in the last year plus. So I want to talk about, I've done an example here. The map, unlike Ryan's really nice chart showing prices versus interest rate increases, the math here is kind of sort of different for every person. There's no sort of one fixed set of rules here. But essentially, what would happen if you took out $1 million mortgage on July 1st of last year? You did a 25-year amortization. You got a prime minus 0.2 interest rate. Here's what your payment at the time looked like. Here's how much went to principal. Here's how much went to interest. How are you doing if you just sort of made your regular payments along the way and you took each interest rate increase, but you kept your payments fixed? You weren't increasing your payments along the way. So from July 1st of last year to September 1st of this year, you've taken a few interest rate hikes. You paid off about $28,000 off your mortgage, and that $4,300 payment, which was going about $2,500 going to the principal before, is now just $700 to principal. Your interest cost has almost doubled as your rate has doubled. You've paid down a little bit of principal. And then with the most recent interest rate increase today, your rate's over 5%, it's 5.25%. And only about $100 of your monthly payment is now going to principal. And so in this particular example, if you are in this situation next week when the Bank of Canada makes their next announcement, and they're likely to increase the overnight rate, as they said they probably will, this particular person with their trigger rate. So a trigger rate essentially is where your current payment, in this case, this $4,300 payment, no longer covers the cost of your interest. So in order to simply service the interest portion of your mortgage, you need to increase your payment. So this is something that potentially some Canadians are dealing with. It's been estimated that about 80,000 mortgage holders nationally are very close to their trigger rate and could be hitting them soon. So it's a small portion of the mortgage market, but not insignificant in any way. And it's something that a sizable number of Canadians are likely to have to deal with in the near future. But from there, when we talk about how are Canadians handling their debt overall, we can look to the debt service ratio. So this is quarterly data, again, for all of Canada. And this red line across the top is the overall debt service ratio. So that is the proportion of your disposable income that goes to service your outstanding debts. And we can see at 13.63%, it's kind of middle of the pack for this last 20 years or so. Canadians haven't really seen a big spike in their overall debt service ratio the last couple of years. And I've drawn a line across here to show that since about the financial crisis, more or less, Canadians were typically carrying a higher debt service ratio than they are today, up around 14, 15%. But the reason for that isn't necessarily mortgages. It's actually this gray line here, this non-mortgage debt. So that's down around 6.59% right now, which is about as low as it's been in the last 20 years. So Canadians have essentially either taken on less non-mortgage debt or paid down more of it, as we looked at with that consumer credit. And their debt service ratios for mortgages are much lower today than they have been historically, while mortgage debt service ratios have been creeping up to about a 20-year high today. Because this is quarterly data up to Q2, this yellow line at the bottom for the Bank of Canada interest rates, it looks a little bit out of date. We'll be getting Q3 numbers shortly, and we'll look to see how this has changed. Certainly, as rates go up, for some, it will be their debt service ratios will go up. But the other factor here is incomes are changing as well. So as your income rises, if say you have a fixed rate mortgage and your mortgage costs are constant, your income goes up, your debt service ratio would actually come down. So there's more to it. But certainly this is one to keep an eye on for the overall health of the mortgage market in Canada. The other one we like to look at here is the mortgage arrears rates. So that is the number of mortgages, the percent, which are 90 days or more late on payments. So unfortunately, this one is a lagging indicator because if you stop making your mortgage payments today, you wouldn't actually show up in the numbers until January when you actually became 90 days late. But we can see a couple of things out of this chart that I like to point out anyway. One is that we are incredibly low here in BC at 0.11%. So about 11 out of 10,000 mortgage holders are 90 days or more late, which is less than the national average. It's second in the country. But the other thing to point out is that this number has been declining over time. So fewer and fewer mortgage holders in BC are actually falling behind on their mortgage payments. And historically, Canadians, through challenging times, they do make their mortgage payments. They'll change their budgets in other ways. They won't walk away from their homes like they do in the US. The difference being we have recourse loans here. In the States, they have non-recourse loans where you can sort of walk away more easily. But generally speaking, Canadians will make their mortgage payments and they don't really get into too much trouble as long as they have that job. And so I know Ryan will talk a bit more about the relationship between the labor market and housing supply later, but I think that's really what it comes back to, is a strong labor market will likely keep these in check. But we'll see as interest rates increase how people can manage them. So with that, I'll kick it back to Ryan.
Awesome, thanks, Ryan. Okay, so we've got about 10 minutes or so just to ride this out, and then we'll take some questions. I guess the one sort of broad question that people have about where we're at is where we're going. We talked a little bit about the context for our market historically in 08 and 17 and 18. The way we look at it is not, we're not making specific predictions per se, but it's more about looking at the bigger picture. And short term, I think we see a challenged market. There's no doubt about it. And there's no way to really sugarcoat it. I think that the uncertainty that exists now is going to continue for the next 3 to 6 months at least. But that said, we do remain optimistic about the region from a prosperity perspective, not just the housing market, but when you look at politically and demographically and economically, we're in a really great place, and we really believe in this region in the long run. So as part of this ride out, there's a few things I want to touch on. It's just the mortgage context. We'll talk about and what that looks like for people who are renewing their mortgages over the next couple of years. It's an interesting little exercise. We'll have a quick look at inventory, again, revisit inventory and that relationship with unemployment. And then a couple of slides on rental housing. We really need rental housing, so we'll show you where we're coming from on that. And then again, some of those macro underpinnings to the market over the longer term that we see as being relevant. So yeah, I mean, inflation, again, very high, and inflation, the Bank of Canada, as it's looking to tame it, is watching all kinds of things. So they are watching different measures of inflation, like core inflation. They're looking at the economy and how close it is to so-called potential output. They look at our labor market and how low the unemployment rate is, how close to full employment we are. Because the closer we are, the higher the wages are rising. And right now they're rising pretty quickly, which honestly, obviously for the average person is a good thing, because prices are rising. And generally speaking, the cost of living has been rising at a pace we haven't seen in a couple of decades. The other thing that the Bank of Canada cares about is what people think inflation is going to be, which sounds bizarre, but inflation expectations are as much an input to the calculus for the Bank of Canada when it's determining how far to increase rates as anything else, any of these other real metrics. And so it's really telling that in its most recent let's call it its most recent survey of Canadian businesses, 78% of the ones that were polled said that the average annual inflation rate will exceed 3% over the next 2 years. And that, if you go back to the other two lines here show just before the pandemic started and then just as the pandemic was started. And even though the shape of those lines changed very clearly, the modal response was 1 to 2%. That even during those times, we all kind of thought that the Bank of Canada would keep a handle on inflation. And so that outlook has changed. So that is concerning because that could point to higher rates for longer. We can contemplate that as much as we want. But what I wanted to show you here is just sort of this context for existing homeowners, let's call it, over the next couple of years. Because I think a lot of people, like Brian looked at those who have a variable rate mortgage and are facing that sort of trigger rate where their payments, one, are eating up less and less principal, but two, are going to go up. Well, what about people who have fixed rate mortgages? And so this line here shows over the last 5 years up to today, or call it the very recent past. This is the going rate was or is for discounted 5-year fixed mortgage rates. Okay, this is what the average person would borrow at if they were originating or renewing at this time. Okay, and so today we're looking at north of 4%. They've come up a little bit since we created this chart, but the story, the narrative, and the themes here remain the same. What's important from an affordability perspective for these existing homeowners is what they're renewing from. So we have to look at that gray line, which shows their existing contract rate. So it was the average 5-year discounted fixed rate from 5 years previously. And so if we put those things together, we can see, and we calculate the difference between what you're renewing at and what you're renewing from. You can see that over much of the last 5 years, renewers were benefiting, right? So they were actually able to renew at a lower rate for the most part until recently, where we've seen the borrowing costs come up dramatically, and therefore that differential grows. So if we look at, sorry, before I get there, actually, I should say this is context for looking ahead. That that rate that is on their current contract before they renew was also they were stress tested at some point. So just to make it easy here, we added 2 percentage points. They would have been qualified at a 2 percentage point higher rate than what they were getting on their contract, essentially, to just ensure that if rates did go up, they could still, by a modest amount, they could still afford their mortgage. So that's the picture over the past 5 years. As we get to today, there's somebody who had a 2.24% interest rate on their existing contract. They were stress tested up at 4.24%, so quite a bit higher. They're now renewing, in this example, at about that stress tested level of 4.24%. So obviously the costs for them from an interest perspective has gone up. But from an affordability perspective, assuming that their job situation hasn't deteriorated, they're still within that affordability range, right? So we now have this differential of 2 percentage points. And the question is, where do we go from here? And I think what's really important to acknowledge is that if you were somebody who renewed their mortgage, let's say, a year and a half ago, and you were able to take advantage of those rock bottom rates, like 1.5%, we have that. We look at that number, and then we look at the going rate today, which might be 4.25 or 4.5 or whatever, and we go, wow, that is like a tripling in that rate. But the reality is, nobody's really facing that dramatic of a change over that period of time, because for fixed mortgages, your fixed rate mortgages, you're locking in for a period of time. So what matters is not so much what the rate was a year ago, but what the rate was for those that are actually renewing today. And that's what that gray line going forward is just the 5-year rate from 5 years ago. And the green line is it stress tested at that higher rate. So when we look at, we could debate the outlook when we survey the big banks and their outlook for bond yields. They expect that bond yields and mortgage rates in the nearest future are going to peak and then start to come back down. And there's a range. There's a range in there. So, but what this shows is that they're going to remain elevated for the next couple of years, and in excess of what rates were 5 years ago, right? But what's important is that they are below the stress tested level as it stands now from 5 years ago. And that's to say nothing of over a 5-year period. I think Brian alluded to this, that most people see their incomes go up over that period of time. Not everyone, but most. And you've also paid down, if you've been diligent enough, you've been paying down your outstanding balance. So you're renewing on a lower amount. This doesn't say there's no issue with rising rates. It just says that the exposure to the rising rates is not as dramatic as it first seems. And households have some time, most borrowers, to adjust their finances and change their spending patterns to accommodate these higher rates. Just touching on unemployment, because I only have a few minutes left. So we talked about that relationship between housing supply and unemployment. And when we look at it more fulsomely over time, we see that there's a very, very good, I'll say correlation because that's what it is here, but I would argue there's a causation in play here, where when the unemployment rate is low, we don't see as much available inventory. Why? Because versus a scenario where the unemployment rate is higher or increasing, and we see, along with that, more homes available for sale. Why is that? Well, it seems to me sort of intuitive that if you're working and you're earning an income, it's a heck of a lot easier to afford your mortgage than if you're not. So if we see an aggregate sort of a big increase in the unemployment rate, well, I would expect at some point the SHIT is going to hit the fan, and people are going to have to get out from underneath their mortgage, right? But conversely, if the labor market is very stable, what this says is that inventory, there's not a lot pointing to inventory rising dramatically. So as we look forward, what we're looking to when we look at our housing market, there's the demand side, but on the supply side, we are watching the labor market quite closely. And this is important because there's a very sort of ingrained trend in our market as it relates to inventory changes through the end of the fall. So we made this sort of joke, there's 3 certainties in life: death, taxes, and a 30% decline in housing inventory. So this is where inventory currently is, total number of MLS listings in the region today. This is what it looked like last year, each month. A historically low year where inventory just fell off at the end of the year. Sales were quite robust. At the end of the year at 6,700 sales with cancellations, terminations. We started January 1 of this year with 6,000 listings, which I think it said sales listings. We've never seen anything like that, right? So that was just historically low. What is the average, the typical pattern of change and level? If we look back over the past 10 years for each month, that's what that red line is. So you can see, again, we're tracking about 20% below where we typically are, but in each of those years and on average, over the past decade and beyond, we see inventory decline through the end of the year by 36% actually. So if we apply that to where we're at now, we would see inventory drop to below 10,000. And this would be one of the very lowest, prior to 2021, one of the very lowest inventory counts that we've ever seen in this region. So the big sort of the factor here that could come into play again is how is the labor market changing? But the inertia in our market is for supply to become even more constrained into the fall. On the rental market, just briefly, this shows shelter cost to income ratios for major metro regions across the country from the latest census data, which were just released. So that's kind of fun for us because we're nerds like that. In Vancouver, second highest shelter cost to income ratio, which means that we're spending a lot of our money, relatively speaking, on our housing. So both for renters and for owners. For renters, it's particularly high. It's higher than 30%. And so that points to a supply issue partly to me. Another thing that points to a supply issue on the rental side to me is this concept of housing suitability. And so in Vancouver, if we look at rental households, Metro Vancouver, we have I think the third highest proportion of rental households that live in unsuitable conditions. What does that mean? There aren't enough bedrooms for the occupants of the dwelling, and given their relationship. So there's all kinds of, it's a fancy equation that StatsCan does. This is a StatsCan measure, but basically they look at the relationship between the people in the household, parents versus kids versus couples versus unrelated people, and they determine whether there are enough bedrooms or not in your household. So Vancouver's very high on this list, again pointing to likely a lack of suitable or available supply of rental housing. we look at the rental housing stock back in 2011, what's interesting is more than 2/3 of it, seven out of 10 dwellings were purpose-built. Over the last decade since then, where has all the growth in our rental stock come from? The secondary market. So mom and pop investors, right? Not the purpose-built segment. So we are not adding en masse huge amounts of rental housing. We have been in the last couple of years, but over the past decade, we have not been. We've definitely been underserving our market. And so we look at it on a municipal level within the region. We compare along the bottom the percentage of our rental, the percentage of our dwelling stock that's rental versus on the y-axis, the percentage of our stock that's in apartments. Very, very strong relationship. And you kind of go, duh. But the point here is if you actually want to alleviate some of the stress in our housing market, particularly for people who are renting, you could argue that's the most important form of tenure in our market. Municipalities need to find a way to add density because that is where we're going to see the rental stock grow. We need those houses, those homes, I should say, very much because we are a magnet for people out here. So if we look nationally at international migration, this is of all types, permanent residents and temporary residents who have permits, either work or study. We're on pace for 1.8 million international migrants coming to Canada this year. That is a huge number. That's not a net number because people leave and there's other dynamics at play, but the incomers would be a record by about 30%. So, this is important from an economic perspective. We need these people to work, but we also have to house them. And we're seeing it on the domestic front as well. Since the beginning of the pandemic, 60,000 people almost have come west on a net basis. Who's second on the list? Probably not many people would expect that it would be Nova Scotia, but it is 25,000. And there's the rest of the provinces in Canada. So we've seen a hollowing out of central Canada in a sense, and a bifurcation of migration flows to the East Coast and to the West Coast to the benefit of BC and its economy. But again, we need to house these people. Longer term, this is not a 3, 6, or 12-month thing, but we look underpinning the market. In addition to migration and a strong economy, we have all this household savings that have been building up since the beginning of the pandemic. People are spending their money in different ways, and also saving money. It's a bigger pie, right? So incomes have gone up. So we know that spending has fueled inflation, but people are also saving more. So that money is going to end up making its way into the markets for all kinds of things, including housing, which, for first-time home buyers, it's great. But to the extent it's with existing homeowners, that could feed into issues of increasing prices over the longer term. And then another thing too is this idea of mortgage-free equity. So look across the region, there's $415 billion of equity in homes that have no mortgage, just in this region, right? So I look at this and have a concern about the haves and the have-nots, because a lot of this money is going to be passed on to the next generation. But not everybody will be the recipient of it. So on the one hand, there's that. On the other hand, we know that that could create a stimulus for our housing market to continue to grow over the long term. And I'm going to cut myself off here so we have a couple minutes for questions. But if I look at sort of where we're going over the long term, or where, let's call it the next 6 months, let's call it that. I sort of look at where we're at as, we're in a storm, right? Some of us are on a plane that's already in the air. We're going to fly through the storm. We're going to hang on tight. It's going to be bumpy. So existing homeowners, developers who are selling projects or building homes, everybody's going to stay the course. Businesses that are operating will stay operating, but it's going to be tougher. For those of us that are still on the ground and haven't taken off yet, we're probably not going to take off for a while. We're not going to take off into the storm. So who's on the ground? It might be first-time home buyers. It's anybody making a big move-up decision in the housing market. It's developers looking to, or those financing new projects, or businesses looking to invest, make big investments. I think we're going to see a pause on that activity for some time now, and I think really we have to get the inflation and interest rate situation under control for that weather to calm itself. That's it for now. We'll see if we can squeeze in a question. Sorry, went a little bit long.
That was great, you guys. Thanks so much. We've got a couple really interesting questions here, so why don't we get started with those? Where are interest rates going? I've heard that they could hit 9% and stay there until 2028.
Right. Yes, so everybody has an opinion about interest rates. That's an aggressive one for sure. I think that when people say they think interest rates are going to a particular place, you have to ask them why, because the interest rates reflect economic conditions, policy decisions. So, I think one view is they'll continue to increase. I think I am not even going to guess where they might be later next year, because there are a lot of dynamics in play. I think in the short term, the Bank of Canada meets next week. Given the inflation rate data that came out or the inflation data that came out yesterday, they're going to go up by 75 basis points. So we're looking at like a 4% policy rate for sure. And we're seeing bond yields go up. So we are likely to see in the shorter term fixed mortgage rates to go up. The other, but if I had to guess, if we're able to if the inflation data continues to be stable and comes down slowly over time, I think we'll see a pullback on the interest rates to the point where they're not increasing them after December. It's contingent on the data, but we might see that, which means then the economy then can sort of digest the interest rate increases, and I expect we'll see in the latter half of next year rates certainly come down. Another view at the other extreme to the 9% is that rates are going to snap back to close to 0%. Nobody on this call should go out and buy property on that basis or advise their clients that rates are going to 0%. But a Nobel Prize winning economist thinks that the central banks have overshot. We don't know that because it takes 18 to 24 months for rates to filter through the economy. But if we start seeing some negative labor market consequences, it's possible that banks move in the other direction. So all I'd say is huge range of outcomes that are possible. We really got to watch the data month to month.
Great. Thanks, Ryan. So let's get through another one here. Question, are we headed for a recession?
Good question. I often wonder when people ask that, why they care. And what I mean by that is like a recession has a very technical definition of 2 consecutive quarters of negative GDP growth. So it doesn't impact everybody in the same way. And I would say it's a binary outcome, like we're in a recession or we're not in a recession. So if GDP growth over 2-quarter periods, in each quarter is minus 0.1% versus it being 0.1%, it's a very small differential, but based on the definition, one scenario is a recession, one isn't. But the functioning of the economy is going to be very similar, all else being equal, in those 2 scenarios. Whereas 6% growth in GDP over a period versus 3%, that has very different implications for different sectors, governments, houses, and that kind of thing. So I tend not to get too hung up on the R word itself and whether we're going to be in it. I'm just looking at how the market, how our economy is evolving, because it tells us who might be impacted, good or bad, by the changes. So, in 2015, there was an inventory-led recession, which we don't need to get into the details, but nobody noticed it. Unemployment rates didn't go up, but technically we were in a recession. It came and went. It was because of the source of the downturn. So I look ahead and I say, well, listen, if interest rates keep rising and businesses have to cut back, we're going to see that across the board. From a housing market perspective, what I want to know is how much are rising interest rates and high interest rates impacting the supply that would otherwise be coming online. Like maybe we're not seeing a lot of homes added. Maybe it just becomes completely unaffordable for people to purchase a home. And then we see a slowdown in the mortgage market, in the insurance market, in the construction market or sector. And so that's sort of the way I look at it, rather than trying to answer the question directly of whether we're going to be in a recession or not. But we could be in 6 months from now. We'll see.
Well, thanks, you guys. I think that's all we have time for today. This kind of knowledge definitely gives us all an advantage in what we do, especially when we use it to underwrite our opinions. So thank you once again. And before we sign off, if you are a guest here today and would like to learn more about a career here at Rennie, I'd be happy to meet you at our brand new head office in Kits to learn more about your business and to share with you the resources, support, and opportunities that are available at our organization. So I look forward to hearing from some of you. And thanks again, everyone. Have a great day, and I look forward to seeing you next time.
Thank you.
Thanks.